Good afternoon, everyone, and thank you for joining. We're going to let everyone continue to log on and get started at about 12:05. Thank you. All right, let's go ahead and get started. Hi, everyone. Thank you for joining today's webinar, 2022 Healthcare Industry Tax Update. Today's program will be presented by Scott Mariani, Partner and Practice Leader, Haley Schulman, Senior Manager, and John Smith, Supervisor in Withem's Healthcare team. As a reminder, due to new tax updates, this webinar will now offer 1.5 CPE credits and will end at 1:30. Before we begin, I have a few notes. At the bottom of the toolbar on the right of your screen, you will see a questions box. Feel free to send us your questions during the presentation. We will do our best to address them. There will be 6 polling questions throughout the program. To qualify for a CPE credit, you must participate in each poll. CPE certificates will be emailed to you within a few weeks. And finally, once the webinar is over, there will be a pop-up asking you to complete a survey of today's webinar. Please take a moment to complete it. It is our way of being able to provide you with the best and most relevant programs possible. With that, I will turn it over to Scott.
Great. Thank you, Rachel, and good afternoon, everybody. Thanks for joining us today. Really 3 takeaways. Number 1, we're going to talk about a lot of the federal tax issues that we deal with on a day-to-day basis and really throughout the year over the last 12 months. But also importantly, we want to note everybody that there are important state tax considerations relative to a lot of the things we're going to talk about. And in all 6 sections of our tax presentation here today, we'll talk not only about federal issues, but also state tax considerations along the way. That's point number 1. And point number 2 as well, we will be giving real life examples of areas that we've talked about and dealt with our clients that we think everybody will find valuable over the course of the presentation. And number 3, we're offering 6 polling questions. They'll be at the start of each of the 6 parts. So if you want to join us for all 6, we appreciate it, and everybody will get 1.5 credits. Today's agenda is broken out into these 6 parts. I will be kicking it off with corporate structure and tax considerations, both federally as well as state issues right now. So Rachel, if you want to move the slide, please.
Yep. So we are on to our first polling question. Does your organization maintain a written policy which is reviewed and followed prior to participating in a joint venture? All right, about 30 more seconds. All right, I'm going to go ahead and close it out. And here are the results. So 48% of you are not sure.
Okay, and we asked that question primarily because a lot of our tax-exempt 501c3 healthcare clients today are entering into ancillary healthcare joint ventures with for-profit entities. So in part 6 of the Form 990, there's a question that asks, were you engaged in that type of joint venture in the current year? And when you do enter into those types of joint ventures with for-profit entities, do you follow a written joint venture policy to make sure that there's adequate charitable tax-exempt safeguards in the joint venture policy, that you need to answer those questions, yes or no, and also explain. So as a best practice, you obviously would like to have a written joint venture policy. So I'm going to get going into corporate structure and tax considerations. And the big takeaway here is we spend lots of time with our clients in the finance area with types of entities. And whether they're comma incs, for-profit businesses, tax-exempt corporations, partnerships, the corporate structure and the formation of these different types of entities is really important for tax purposes. You know that at times you have legal incorporating new entities, you have operations people out there engaging in new business activities, programs, potential joint venture partners. And as a best practice, we always look at the corporate organizational chart for entities and also identify what type of entity they particularly are. So obviously, you know, tax-exempt corps, 501c3s, taxable corps, we call those comma incs. They generally file Form 1120. Partnerships or flow-through entities, they pay no tax. They issue K1s to their partners. And importantly, too, limited liability companies could be 3 different structures. One, it could be a single member LLC, meaning it has one owner only. And in that instance, it defaults to the status of a disregarded entity, generally for federal purposes, but not always for state purposes. And we're going to talk about that. One or more members in an LLC is generally defaults to taxation as a partnership, but you can elect out and be taxed as a corporation. And then also, too, limited liability companies could be designated as a sole proprietor. And for example, a doctor can form a single member limited liability company and report that on his or her Schedule C of the 1040 on an annual basis. And these types of entities and the proper identification, John's going to talk about with respect to 1099s and W-9 issues in the next part of this presentation. And 2 comments on S Corps. Number 1, if you're a 501c3 entity, you never want to structure an entity as an S Corp that issues a K1 to a 501c3, because the IRS code specifically provides that income or loss reflected on a K1 from an S Corp will always be unrelated business income or loss. So we really don't like S Corps when we're dealing with 501c3s. And you also take away with S Corps, greater than 2% owners in S Corps, fringe benefits are not deductible by the S Corporation unless included on the W-2 of the S Corporation's owners. So if you have S Corps with only a few members that own more than 2% of the stock of the business, we generally would not recommend an S Corp either, because those are non-deductibility items generally. So on the next three slides, I'm going to talk about limited liability companies. And Rachel, if you'd flip the slide here. Again, LLCs taxed as partnerships generally pay no tax because it passes through to the members in the LLC. And this is a quote that somebody kind of threw out to us when we were working with one of our healthcare systems this past year, that the entity is structured as a for-profit. And they were talking about entering into a joint venture ancillary healthcare endeavor with another 501c3 entity. The meeting minutes that we saw, the PowerPoint presentation that we reviewed, all referred to this perceived joint venture between two 501c3s as a for-profit business. So, don't use those words. They're not great tax words, particularly when you're involved with 501c3s that are receiving K1s that we want to treat as related income and not UBI. And that's important too, because when a 501c3 enters into a joint venture taxed as a partnership, the entity steps into the shoes of the activity of the LLC. So for example, if you have a 501c3 hospital that is a member in an LLC that's an ambulatory surgery center, it's as if the hospital is performing the ambulatory surgery center activities. So they step into the shoes of the business. But moreover, if we refer to a for-profit business, the argument of it being a related or an unrelated business, the IRS looks at those things like corporate minutes, PowerPoint presentations, statements of the owners, statements of the hospital executives, and we never want to refer to activities that we want to treat as related as being a for-profit business. So UBI consideration number one, obviously the underlying activity could be unrelated. Conversely, here's an example of clearly an unrelated business. We have a 501c3 entity that's a healthcare provider, and the LLC owns a McDonald's. Well, clearly the activity of selling, cheeseburgers and French fries and Diet Cokes to the general public would not be a related business to the 501c3 healthcare provider that owns an ownership interest in the McDonald's being carried through the LLC, and that would be an unrelated business activity potentially for taxation. So UBI consideration number one, always look at the underlying activity. On the next slide here with LLCs, we also need to consider the ancillary healthcare joint venture, i.e. the first polling question. When we have a C3 that enters into a joint venture with a for-profit partner, in order for it not to be taxable unrelated business income or loss, the IRS wants the exempt to control the joint venture. How do we control the joint venture? By owning 50.1% or more of the LLC, or the operating agreement has certain safeguards to ensure that the LLC activity will always operate in furtherance of the charitable tax-exempt purposes of the 501c3. We call it a charitable purposes provision in the operating agreement. There's also veto powers in the operating agreement that if the LLC would enter into something that it deemed to be a potential tax-exempt status issue of the member in the joint venture, that the parties have the right to arbitrate it and potentially not proceed with that type of activity that could jeopardize the member's exemption, or the 501c3 could actually get out of the LLC. So either or, we have either of those. We like to see both, but if we have either of those, us tax practitioners generally would recommend that K1 income would be treated as related and not unrelated business income. And I already talked about Form 990 Part 6, questions 16A and B. Next slide, Rachel, please. Okay, here's something really interesting that we've been working with. And again, I use the example of two 501c3s that want to do a joint venture. And, it's always the fault of the attorneys to, let's form a partnership. Let's form an LLC. It's taxable as a partnership. And both of our C3s will get a K1. We'll treat it as related. We believe there's a better way. And a better way today is basically you can form an LLC. It would elect corporate treatment, but it files an application of Form 1023 with the IRS. And the IRS is granting tax-exempt status to LLCs owned by one or more 501c3s. There's an IRS notice there, 2021-56. The owners, the members have to be C3 entities or governmental agencies. There's a contingency plan if a member disqualifies or opts out of being a 501c3 exempt entity. And similar to a certificate of incorporation for your comma incs that file 501c3 applications, you have to have charitable purposes and charitable dissolution provisions. So we believe that this structure is a lot better than K1s, a partnership, an LLC tax as a partnership with two C3s as members. Why? For federal purposes, it really doesn't matter. But for state purposes in particular, a 501c3 entity can get sales and use tax exemption, for example, in many states. Whereas if you're an LLC taxed as a partnership with 501c3s as members, generally it will not qualify for exemption from sales and use tax purchases at a state level. And also a 501c3 entity, we believe part of a healthcare system, for example, is a better tax exempt entity than a partnership with two 501c3 members in that. So we're using it all the time today. We've gotten a number of 1023s approved by the IRS in this manner. And if you're structuring new entities and working with legal and operations people, just don't always default to the LLC status and issuing K1s to one or more 501c3s. So it's really good. It's really workable these days. On the next slide, I'm going to transition a little bit here, which is really neat. And this is what we've been working with a lot of our clients about. And I've got an example in here. It's really, really good. It's known as the BATE, the Business Alternative Income Tax, or also known as the SALT workaround. And as we know, everybody's 1040 and it is tax season these days, right? A lot of people are getting burned by being limited on your Schedule A for only being able to deduct a maximum of $10,000 of state and local income taxes. And that includes income taxes payable to your state, but also real estate taxes. So those states that have high income tax numbers for state purposes, real estate taxes are high, you're being capped at $10,000. A lot of states have gotten into this workaround example, and basically it really, really works well. And the concept is that you pay a tax to your state, it reduces federal taxable income at the federal level, and you get a credit on your state tax return for the amount paid to the state in this example. So it actually works as really well. It reduces federal taxable income and you get a credit on your personal state income tax return, which is really neat. And think of the doctors group and I have an example where there's 10 physician owners in a flow-through entity, an LLC, or an S corporation. It really works great. And in an example where you may have 9 physicians in a partnership and the 10th partner is a tax-exempt entity and it pays no tax, we could still elect the BATE treatment, and that 501c3 entity just applies for a refund from their respective state tax jurisdiction. And it's really great. It's a great planning mechanism. And on the next slide here, I have an example of it. So let's assume we have a surgery center. It's an LLC taxed as a partnership with 10 members. Each are physicians. The LLC has taxable income of $12 million or $1.2 million per member, right? This is a true life New Jersey example that we worked with recently with a client. The LLC itself, it elects New Jersey BATE, Business Alternative Income Tax. The New Jersey BATE tax on 12 million is approximately 1.2 million. So that 1.2 million is paid to the state of New Jersey. It reduces federal taxable income for the LLC, which passes through to K1s to its members. It reduces it to 10.8 million rather than 12 million. So basically, by that $1.2 million payment to New Jersey, it reduces the federal K1s going to the physicians. 1.2 million at the maximum federal bracket is 37% right now individually. There's savings of $440,000. Okay. Now that $1.2 million payment is not lost. It's not paid to New Jersey in perpetuity. It's paid to New Jersey, but then the K1s that we prepare for the 10 physician owners reflects the pro rata amount of that $1.2 million on their respective K1s. And they claim a credit of $120,000 each on their New Jersey Form 1040. So they're not out any cash. It's really just getting a deduction at the federal level, and then the tax credit is taken on their New Jersey returns. So it's really, really great. This is a $440,000 real life example of what we did. And you can see number 6 already talked about it. If one of the members was a C3, it gets the $120,000 back by applying to the state for a refund of that. Really, really significant savings. Now on the next slide, we're taking it one step further. And I already said I don't like S corps, right? We don't like S corps. I inherited one recently, and this is another New Jersey BATE example. Still same assumption, except number one, we moved W-2 wages from the doctor's W-2s, and we left it in the business, so we created K-1 income, right? And the example here is, right, we've got 10 shareholders. Really, this is a real life example. Their comp was $3.4 million per shareholder. We inherited the S corp as a client. What we did was we did a fair market value study. We got comfortable with reducing the W-2 wages down to 2.2 million each, written FMV study, and we basically left $12 million of profit in the business, which will pass through on K1s. Now under that, my example is the exact same as the previous slide. I have 34 million of comp, moved it down to 22 million of comp. You can see the 12 million there column that we left on the K1s. We elect New Jersey BATE treatment, 12 million. The New Jersey BATE payment is 1.2 million. I reduced my federal taxable income to 10.8. My savings are 440,000. Well, what else am I saving here? I'm saving FICA tax on the W-2s. I'm saving 2.35% on the employee side. 2.35% at the 12 million is another 282,000. On the employer side, it's the 1.45%, 174,000. So in this example, by electing the BATE treatment and moving W-2 income over to K-1 income, we are going to save $896,000 this year. 174,000 at the employer level and 722,000 at the shareholder level, flowing through, and they each save $72,000 in tax in this example. If you have flow-through entities owned by, for example, in this example, obviously physicians and or 501c3s, it's a no-brainer. You should be looking at it. About half of the 50 states have enacted SALT workarounds. New Jersey has, New York has, Pennsylvania has it on the table. They are not there yet. But check out your respective state jurisdictions. Check out the rules, the elections, the timings. Significant tax dollars can be saved here. A couple other things on the next slide we're working with our clients on. Real quick, corporate practice of medicine states and tax-exempt PCs, they're hybrid entities. They're obviously exempt at a federal level, but at a state level, they are not exempt. They file corporate income tax returns. So you have to think about, potentially paying tax on a state level. Also, in some states, they don't get exemption from sales and use tax because they're a hybrid. In some states, they do. Again, you got to look at your state issues. Here's another one too, at corporate practice of medicine states. There is a private letter ruling or two out there where if you have a taxable PC, but both at a federal level and a state level, and you have an MSO entity structured as a C Corp, and these are all C Corps, there is an opportunity to file a consolidated corporate income tax return with the PCs and the MSO. So that's an idea for planning as well, as opposed to going 990 treatment at a federal level and leaving them as for-profits at a state level. So you need to check out your income and expenses of your PCs as well as your related MSO, and maybe do a private letter ruling and or work with legal counsel and elect consolidate corporate income tax return treatment. That's pretty neat. We're looking at that with a number of clients. And then importantly too, just something here you have to think about as well, our single member LLCs, they default to disregarded entity treatment. Right, their sole member files the tax returns, but not in all states. Again, this is another state issue that we're dealing with, particularly as our healthcare systems go across state lines. We have a number of healthcare systems now in 2 or 3 states, and all the state rules are different. So in one state, a single member LLC owned by a C3 is exempt from sales and use tax. In another state, exact same healthcare system, guess what? That single member LLC owned by the 501c3 does not get sales and use tax exemption in that state. So really, is that the best model to do for corporate structure purposes? If it is, and we decide to leave it that way, you need to think about your sales and use tax purposes. Again, jurisdiction by jurisdiction, type of entity is real important, federal as well as state. Again, just certain things that we're working with all of our clients these days we thought would be beneficial. On the next slide, I'm not going to cover. I've already kind of talked about all these sorts of things other than type of entity, corporate income tax rates, state sales and use tax considerations, and also local property and municipality considerations. as you look to forming new companies, inherit companies through affiliations and mergers, type of entity, tax ID number, exempt, non-exempt, federal, state. You need to think about all these sorts of issues. On the next slide, I've got group exemption rulings. A couple of comments on this before we wrap up this part, right? So group exemption ruling, you can file a consolidated 990 for your subsidiaries. There's a whole bunch of advantages. You know, you form a new 501c3. It elects to come into the group. You don't have to file a separate exemption application. That's good. It also you also don't show as many employees' compensation on a consolidated 990 as opposed to separate 990s. That's good. And generally Schedule H as well, you file on a consolidated basis. That's good, but can also be bad if you want to try and show your community benefit on a hospital by hospital basis. Appendix C has reporting requirements. On the next slide, you've got an IRS notice, and the IRS is going to be issuing formal guidance, hopefully soon, but on this slide here, these are some of the new requirements that the IRS would be asking for group rulings. And then on the next slide here, we have the IRS coming out and saying, wait a minute, it was supposed to be issued this year, but wait a minute, we're still actively working on a final rev proc that would enact some of the changes that the IRS would want on a group exemption ruling. Now, in practicality, things that you don't think about until you get into the weeds here with a group return. We have clients that have them, as some systems have gotten bigger, some of our systems have not. Here's one we've run into recently, a name change. A name change on a subordinate organization, a hospital. They need a new tax letter recognizing the tax ID number and the new name of the entity for Medicare purposes. Well, the IRS doesn't recognize separate tax exemption for the subordinate anymore. Number one, that's a problem. Number two, annually, 90 days before the end of the year, you're supposed to send to the IRS the annual group exemption update letter, which outlines name changes, address changes, new entities that came in and entities that came out. So what's the notification procedure here to send in just a name change on a group ruling of subordinates and get a new group exemption letter? Because it doesn't have a separate IRS tax determination letter anymore in a group ruling setting. So we had to go through some hurdles. We had to contact the IRS these days, which is not an easy thing to do. And it's just these types of things that you don't, when you get into kind of the weeds of the day-to-day things, it's not so easy to do from a group exemption perspective. So you want to take a real hard look at whether or not it's going to make a lot of sense under the new rules for the group exemptions, which hopefully will come out this year. We shall see. Next slide, Rachel, please.
Okay, we're on to our second polling question. Which of these characteristics can determine employee versus independent contractor classification? All right, about 30 more seconds. All right, I'm going to go ahead and close it out. And here are the results. So it's like 89% voted all of the above.
Great. Thank you, Rachel. Yeah, that's great that everyone answered all of the above. You know, we're going to cover that in a couple slides in this employment tax section, but you could see there those three factors your organization should really review when determining if an individual should be categorized as an independent contractor or be issued a W-2 and be an employee for your organization. So this next section, we're going to cover employment tax and some things, including, employee retention tax credit, 1099, NEC items, and some audit issues we've seen coming down the pike. So Rachel, if you could just switch to the next slide for me, that'd be great. All right, on the first slide here, we're going to talk about the CARES Act. So as part of the CARES Act, the employee retention tax credit was part of it, and that was enacted in March of 2020. Hopefully folks on this webinar, have taken advantage of this credit or thinking about taking advantage of this credit. Just a little background on it. It's a fully refundable tax credit, which is meant to help organizations who kept employees on the payroll, during the pandemic when, times were a little bit tough, and, keep those people employed. There's measures that your organization is required to meet in order to qualify the employee retention tax credit. Their operations are fully or partially suspended during the calendar quarter due to an order from an appropriate government authority limiting commerce, travel, or group meetings, or due to COVID or a significant decline in gross receipts. In 2020, that significant decline was a 50% decline in gross receipts from the prior year or similar period. In our experience, we've seen that large integrated healthcare delivery systems would not really be eligible under this 50% decline in gross receipts test, but we'll discuss in the next slide when we get to it, other ways that healthcare organizations are eligible for this credit. Just a little background, the credit is applicable for wages, qualified wages, which were paid between March 12, 2020 and January 1st, 2021 during that government shutdown period. The qualified wages include items like medical benefits, health and dental and vision, and then also wages paid to these employees. The 2020 ERTC maximum credit was $5,000 per employee, which is calculated at 50% of the maximum qualified wages of $10,000 per employee. And then in order to claim the credit, the organization is required to amend the second quarter June 2020 Form 941 by utilizing the Form 941X. And this can be filed up to 3 years after the original date. So you do have until July 31st, 2023 to amend the 941X and take advantage of this employee retention tax credit if you haven't done so yet. And then down below is just a live link for FAQs that recently were replaced, the original FAQ guidelines, which could be useful for taxpayers just to when they're determining if they are eligible for the employee retention tax credit. This next slide, we're just going to provide some tips to be on the lookout for when determining if you are eligible for the employee retention tax credit. As I mentioned earlier, with large integrated healthcare delivery systems, we would suggest looking at this on a state-by-state basis to determine government shutdown orders. So with our clients, when reviewing this for our New Jersey clients, there was a government shutdown period of March 17th through May 25th, 2020. So we looked at that time frame. And then for PA, it was March 19th through May 9th. So, state-by-state basis changed if there was a government shutdown period. So you'd have to look at on where your organization operates. And then another item we looked at for organizations is employee furloughs. So if you had furloughed employees, but you kept them, they weren't being compensated, but you kept them on the benefit plan and benefit costs were paid by the employer, we believe, these costs can be included as qualified wages and included in the calculation of the ERTC credit there. And then also look at if you have paid COVID-19 pay codes, say you had employees that were working, got COVID during the shutdown period and had to quarantine and stay home, but were still paid, but weren't working, you could capture those wages as qualified wages. And then the next item here, looking at for hospitals wise, looking at your revenue producing clinical departments and analyzing net patient revenue in conjunction with hospital wages and seeing a decline there in your revenue producing departments. And then we have worked with hospitals, physician groups on determining applicability of the employee retention tax credit for the organization. Have had great results for our organizations. We've submitted ERTC claims for organizations, from a couple $100,000 to a few $1 million there. So there is money out there on the table for organizations. This is found money. And you should really review and determine if you are eligible. As I mentioned earlier, you still have some time to file this claim if you haven't done so yet, and you have till July 31st, 2023 to do that claim because the 3-year statute runs out at that time frame. Okay. We're going to transition to the next slide with respect to employment in an employment tax update. The IRS loves to audit have audit examinations in this area. It was on one of their compliance programs and priorities list that it's going to be a continuing area of focus by the IRS in the upcoming years. And whether you're tax exempt or a for-profit entity, you should really pay close attention to these areas. One of the items there are focus on worker reclassification, determining whether individuals, that are employees or should be categorized as independent contractors. If your organization issued a 1099 or W-2 to the same individual, and there's also possible worker reclassification there. Having to look at your 1099 vendors, and if they need to be also, should be categorized as an employee. We've known that the IRS, when they do these audits, they come in and take a full-blown look at your accounts payable file to determine, any issues there. Next item there, taxability of fringe benefits. The IRS may come in, randomly select a number of months with expense reimbursements to, high-level executives and review all the backup documentation with respect to these reimbursements. And then also audits of 1099-Cs, that was new. The form was introduced in 2020. Those are definitely forthcoming, and we see those being on the rise with the IRS. And then lastly here, due with COVID and seeing more organizations moving to a remote environment and having employees working remote now full time, we see states focusing on this as an area to determine if, the organization is properly remitting the state withholding, or also with regards to unemployment contributions, if they're being properly made in the correct states. On the next slide here, we just have a screenshot here of a Form W-9. This is used by your organization or from vendors to request, for the organization to provide a tax ID number and to certify their tax classification. It also helps when determining if your organization is required to issue a 1099 to the vendor. As Scott had mentioned earlier, with respect to corporate structure and limited liability companies, you could see there on line 3, there are multiple tax classifications for LLCs. You could have an LLC that is, files the election to be taxed as a C corporation, an S corporation, or the general rule is that LLCs, when they're first formed, if they have 2 or more partners, members, they're classified as a partnership. And then also you could have a single member LLC, which is owned by an individual there on part 3, and you would check that box. A common question we often get from clients is, they have an LLC that is disregard entity and its single owner is a C corporation. What do I have to do to complete this form? How do I complete this? And the instructions specifically state, when you're completing this form, you're required to list the owner's name on line 1. So in that instance where you have the single member LLC owned by a C corporation, you'd have to list the C corporation's name on line 1. And then on line 2, it should be the disregard entity should be reported there. And then with line, for line 3, since the owner is a C corporation, this box would be checked. And then also you would provide the TIN of the C corporation. So we often get questions from clients, and requesting from vendors, how do I complete this? And the biggest question we see is with those disregard entities that are owned by a C corp and how they should complete this correctly. On the next slide here, kind of coincides with our polling question number 2 with IRS Tax Tip 2021-40. Here it's whether, determining whether an individual, is an independent contractor versus employee classification. There's the 3 items there: behavioral control. Does the company control or have the right to control what the worker does and how the worker does the job? Financial control. Do they have a direct control of the financial and business aspects of the worker's job? Are they controlled by the payer? Things, how the worker is paid, how are expenses reimbursed, who provides tool supplies, etc. That's kind of looked at there. And then relationship to the party. Are there any written contracts, employee type benefits provided there, such as pension, insurance, vacation, things of that nature to determine the type of relationship with the individual. And then also there's a voluntary classification settlement program. This is an optional program where taxpayers have the opportunity to opportunity to reclassify their workers as employees for future employment tax purposes. It offers partial relief there for federal employment taxes for eligible employees, who would agree to prospectively treat their workers as employees. And then, they have to fill out a form 8952, the application for voluntary classification settlement program, and enter into a closing agreement with the IRS. So this is something that you might be able to take advantage of if you need to reclassify some employees. And then the next slide here, another important area that we see gaining attention is the 1099 reporting and the appropriate form to utilize. The IRS created a 1099 NEC and did so, in order for organizations to separate non-employee compensation on the 1099 NEC. We know the IRS loves auditing taxpayers for 1099 compliance and then increased focus on worker classification. This form gives them a good starting point for the audit selection. On this next slide, as I mentioned earlier, the IRS loves to perform these employment tax audits. We've known them to come in and audit the employee, the taxpayer's full accounts payable file. One question you like to ask yourself here is in number one, are workers in the same position being treated, consistently in your organization? You might have on-call OB on-call doctors working, where you give them a 1099, but then you have neuro on-call doctors that are being issued a W-2. So, they might look at that and be like, what's the difference there? They have the same type of financial control, and they meet that 3-factor test there. They should all be treated as being employees and issued a W-2. And then here, sometimes we see when working with it, clients, issuing a W-2 and 1099 to the same individual. That's kind of, the IRS sees that as a red flag there a little bit. If you have an employee that retired during the year, like for example, you have a director of payroll who was, retiring, was paid on a W-2 up to the retirement, and then you brought them back on because of staffing shortages, to work part-time. Did their role really change much? They shouldn't be getting a 1099 for working part-time just because their hours reduced. They still have the same responsibility, same reporting to the same individual, so they should still be on that W-2 for the full year, even though they went into a part-time basis. Here's kind of an extreme example here, where it would make sense to issue a W-2 and 1099 the same individual. You have a cardiologist who cuts the lawn on the hospital on the weekends there, kind of an extreme example, but you can see there, not the same type of services being performed. And, that's an instance where we see that, a W-2 and 1099 can be issued. And then on here, this last item here, we've been seeing a lot here with regards to recruiting and, trying to obtain talent in your hospital and maintain talent in your hospital. Say you have an individual who's, performing a residency at, competitor hospital, and you offer them a stipend in order to come work at your hospital and perform their residency there in the upcoming year. You really need to review that and, determine if that stipend should be a 1099 or W-2 for this individual. Because we've seen a lot of organizations utilizing these tools, in order to, retain talent or bring in new talent. And just, as we know, there's been a shortage of workers and, shortage of doctors and medical professionals in the field. Then our next slide, so here are some best practices for limiting 1099 exposure. We've been doing a lot of work with clients in this area. As healthcare organizations, make sure you're taking advantage of the 1099 miss where applicable and making use of the box 6, for medical and healthcare payments. Some real life examples, we've seen some organizations with regards to 1099 audits, that they submitted some 1099s without EINs or social security numbers or incorrect ID numbers there. And, that's an automatic red flag with the IRS. Not only does it subject the organization to penalties for not furnishing the EIN or correct social security number, but they could be subject to 28% backup withholding for also not having that W-9 on file. So that's what we also say, in bullet point number 3 there, is just make sure you get a W-9 from all accounts payable payees on file, even if you're not required to issue a 1099 to that individual. Can really help limit your exposure to that 28% backup withholding. Also, there's, take advantage of the IRS TIN matching program. It enables you to validate tax ID numbers of entities. Also, perform an annual review of your non-1099 required vendors. Make sure they're properly classified as well. And then, another thing, annual review of both payroll and accounts payable to determine if you had some of those individuals that were issued a 1099 and a W-2, where they shouldn't be. Make sure you're properly reporting there if they should just be on a W-2 only. The IRS loves seeing that, you have those two there, and could be a big red flag there from the IRS. And then lastly, just, try to maintain, update internal 1099 miss NEC policy. The IRS loves seeing policies. We would suggest, if you don't have one in place, really work on getting one in place just in case you are selected for one of these audits. And then the last item here we'll cover quickly here is remote workers. We've seen a lot of states looking into this with, now workers now working full-time remotely. During the pandemic, a lot of states, kind of relaxed their rules a little bit and offered relief for employees that are working from home. But that's certainly changing. Now states are requiring that employees should resume, sourcing income based on where the service or employment is performed. And then here's some employer considerations. They need to make sure that they're registered, their organization in these states where they do have these remote workers, proper withholding is necessary. Or if there's states that don't have the withholding there, making sure your other rules are in compliance with, like state unemployment, making sure you're signed up there with the Department of Labor and registered properly. And then it's also really on a state-by-state basis. Rules are different, especially for 501c3 organizations that you may have that one-off where there's an employee working in North Carolina remotely full-time. You may not be required, you will be required to do withholding requirements in their state withholding, but you may not be required to, register for unemployment insurance. You might not meet that requirement that having, 4 employees working for a minimum of 20 weeks during the year. So you might not have to register, but, you can voluntarily register for some of those items. So that's something to look at, and really look at it on a state-by-state level there. I'll pause here before I hand it off to Haley. I know we have another polling question to go over with everyone.
Here is our third polling question. When was your organization's financial assistance policy last updated? All right, about 30 more seconds. All right, we go ahead and close it out. And here are the results. Looks like majority is unsure.
Hopefully that's not applicable. Unsure is scary. And if you are unsure and you are employed by a tax-exempt hospital, definitely something that you want to take a look into, because as you know, Internal Revenue Code Section 501R continues to be an area of focus for the IRS. And you can flip the slide, Rach. So continues to be a focus, an area of focus for the IRS. The IRS is required to review each hospital's community benefit activities once every 3 years. And what we've found really is that while they're doing that, they're also typically reviewing compliance with respect to 501R. We know that Senator Grassley and the Senate Finance Committee has been heavily invested in this area. Although they've been a little quiet lately, we suspect that that won't last for long. It's inevitable due to all the bad press that's currently being put out there related to tax-exempt hospitals' compliance or abuse, essentially, of 501R. For example, on the next slide, this article was released about a month ago, and basically the Washington Attorney General is suing Providence Hospitals, which includes 8 hospitals, as well as 5 Swedish health hospitals for failure to provide discounted or free care to low-income patients. The complaint actually alleges that Providence employees have been trained since 2018 to use aggressive collection tactics that create the impression that all patients must pay regardless of their income status. The Attorney General also stated that Providence has sent over 54,000 patient accounts to third-party collection agencies, even though the system knew that patients were eligible for free or discounted care. So this is, this is not the 1 in a million. This is kind of what we see going on. Even on the next slide, we'll see another article that was released within a day. And this is all within the last month. Another example of some bad press where a North Carolina patient is suing Vidant Health and basically accused the system of deceptive billing, overcharging, and using manipulative collection practices. And unfortunately, these are the types of circumstances that give rise to increased scrutiny by the IRS and as well as the general public. And on the next slide, we're just want to illustrate that this isn't just a federal issue. What we see is that states are obviously becoming more involved with 501R and certain regulations. Over the last year, at least 10 states have enacted laws that affect healthcare providers and collection agencies. And there are currently 2 other states that are considering bills that will include or bolster consumer medical billing protections. And on the next slide, IRS is, continues to enforce 501R for the fiscal year 21. The IRS released in their fiscal 21 accomplishments letter that they completed over 1,000 501R reviews, and of that, 71 hospitals were referred for examination. Now that number 71 is down from the prior year, so we are seeing some more compliance generally, but really what these are being referred for is because of the lack of focus. Well, they're focusing on whether the organization has their CHNA made widely available, and also compliance with respect to their financial assistance policies. On the next slide, we've been talking about 501R for a while now, and largely it's focused on R4, 5, and 6, which is your financial assistance, billing, collection activity. But we are seeing a rise in some information with respect to community health needs assessment. For instance, in June 2021, the JAMA Network released a report, and the report basically illustrated a study which randomly selected 500 of just about 1,600 nonprofit hospitals in the US. They reviewed their 990s, downloaded the community health needs assessment and implementation strategies from the the hospital's websites. And we've included on this slide for you to take a look at the results. Basically, 84% of that sample had their CHNA on their hospital website, whereas only 75% had the implementation strategy. 60% of the sample had both. And ultimately, what they issued was a mean quality score of 3.2 out of 5, and that was really due to missing required information that should have been included in either the community health needs assessment or the implementation strategy. And on our next slide, we just wanted to kind of bullet point and give everybody information on what we see when we take a look at things for both clients, non-clients, when folks contact us to do a review. With respect to 501R3, most common mistakes include the current and prior community health needs assessment not being posted on the website. Remember, you've got to have both of those. We also see that when your new community health needs assessment is released, you should be also including a section that addresses the impact of actions taken since the prior community health needs assessment. And that, a lot of the time we see it is not being included. What hospital organizations do to kind of remedy that situation is put out some material which is made publicly available kind of right next to the CHNA to address that information. We also see that the implementation strategy is not posted on the hospital website, but again, that's not required. It is an industry best practice, and we have found that it kind of helps eliminate unneeded 501R compliance checks from the IRS. With respect to 501R 4, 5, and 6, issues that we most commonly see is either no reference to the AGB or an AGB percentage that hasn't been updated since 2017, 2018. If you are publishing your AGB percentage, you really need to make sure that that's updated on an annual basis. We also see the lack of LEP translations, and kind of where that comes into play is sometimes, you know, hospital systems have the same primary service area, but when you're looking at one hospital system's LEP translations and they've got it translated into 6 languages, and another and their neighboring hospital only has it in English and Spanish. So really, organizations, we encourage you to benchmark yourself kind of against your local peers just to see if you are in line. Also, with respect to missing provider listings, sometimes they're referenced as an appendix, sometimes they're included within the FAP themselves. Just make sure that those documents are continuously updated. It's a safe harbor to update it at least quarterly. And you also want to keep in mind that, you know, with all of the work and joint ventures that we see going on today, and Scott touched upon the opportunity there, not only should this be updated, but it should be evaluated for unrelated business income purposes. If you have a joint venture that is performing services within the hospital facility itself and they don't follow your FAP, that could be subject to unrelated business income. So definitely continue to review that for compliance. And then really the biggest thing is you know, website links break. So annually, or probably better, more than annually, check your links for the financial assistance policy, plain language summary application. Make sure that anything you're referencing within the policy itself is attached or made widely available. And a word to the wise, make your financial assistance information as easy as possible to find, because the less time the IRS has to spend trying to track it down, the less likely you are to receive a compliance check regarding this. And with that, I will turn it back to Rachel for our next polling question.
Great, thank you. And our 4th polling question: does your organization provide EHR technology to medical staff or community physicians? All right, 30 more seconds. All right, I'm gonna go ahead and close it out. Looks like the majority voted yes.
Okay, so I guess we're going to use the word epic, 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 right? So that's all we hear these days with electronic medical records. We're doing an epic implementation. We're working with our vendors. We're working with our physicians, medical staff physicians, own physicians, and community physicians. So whoever thought that something like epic, epic, epic also creates tax reporting obligations. So I'm going to chat about this for a couple of minutes for both a federal level and 1099 reporting, and then also for sales and use tax purposes at a state, local municipality level. So actually there was an IRS memorandum all the way back to 2007 that basically said, hey, you know, Department of Health and Human Services now recognizes that hospitals and healthcare systems can help subsidize physicians, and it would not be violative of the federal anti-kickback laws or statutes or the physician self-referral laws, also known as STARC. So the IRS came out and said, hey, as long as we comply with DHHS rules for IRS purposes, we're also going to recognize that tax-exempt hospitals, healthcare systems can subsidize physicians with respect to the implementation of an electronic medical record. And, you know, typically prior to this ruling, we would think about things as fair market value, charging for assistance and the subsidy, private inurement, private benefit, revocation of tax-exempt status, and even potential possibilities of intermediate sanctions and excise taxes. So that really didn't gain a lot of attention until obviously the Affordable Care Act came into play in 2012. And then all of a sudden we heard EPIC and let's help and work with our physicians moving toward an EMR. So on the next slide, we've put forth the regulations that as long as these are met, we can subsidize the physicians with respect to EMRs. Number one, the hospital must have access to the EMR created by a physician using the health IT items and services that the hospital subsidizes. Generally, the health IT items and services must be available to all medical staff physicians. And generally, you have to offer the same level of subsidy to all of your medical staff physicians, or you vary the level of subsidy by applying criteria which is reasonably determined based upon the healthcare needs of the community. So for example, if you're in an area where there's a dire need for primary care physicians, you can probably offer a greater subsidy to that of certain medical specialties, let's say oncologist or cardiologist, et cetera, et cetera. So in that instance, with documented need, you can vary the amount of the subsidy or the support of the physicians. So what does that create? So on the next slide, us tax folks always don't have great news, but what does that create? Number one, a 1099 reporting issue. And as John alluded to in the second part of the presentation, the IRS loves to do employment tax audits and non-compliance with W-9s and 1099s. So you can offer up to an 85% discount on EMR subsidies. That's under the DHHS rules, which the IRS follows. So what happens if the hospital, offers that 85% subsidy to a physician group? The value, of the whole Epic implementation and the software, hardware, et cetera, let's say is $100,000. You offer an 85% discount because it's for the community and it's part of the program and it's documented. And you offer the 85% discount and the physician pays 15. So for 1099 reporting, the physician got value of 100 for which it paid 15. We believe that the appropriate documentation on documenting the value would be a 1099 for that discount or the 85,000 in my example. Beware, check those things out. Talk to your IT folks, talk to your operations people. That's a very real issue. Second issue is, and again, this goes to the states, sales and use tax issues. We have hardware, software, technical support, training, installation, and troubleshooting. That raises sales and use tax issues based upon the type of entity. And I spent a lot of time in the first part of the agenda talking about C Corps, taxable PCs, single member LLCs. Depending on the state and the type of corporate structure and the tax classification, you might have sales and use tax remittances and obligations that arise as a result of the EMR subsidy to both related for-profit PCs, but clearly to unrelated for-profit PCs. And again, with our states, with our multi-healthcare entity systems in various states, you got to look at each state statute because each are different in this area. So I want to spend a couple minutes and talk about that. On the next slide, we're going to transition here a little bit to state sales and use tax exemption issues at a municipality level. They're all over the place. Haley did a great job of outlining a whole bunch of state initiatives. This is something that we've been following closely in Pennsylvania and working with our Pennsylvania clients on. And Tower Health is a 6-hospital system in Pennsylvania. They lost tax exemption for 3 of their Chester County hospitals. And on the next slide, I've outlined the 5 criteria, which is known as the HUP standard for tax-exempt entities to qualify for exemption in the Commonwealth of PA. And number 1 and 2, the court found problem with this arrangement. Number 1, you need to advance a charitable purpose. And number 2, which is very difficult, right? You need to operate entirely free from private profit motive. And the judge's decision is interesting on a couple of things. Number 1, he talked about underinsured versus uninsured. And he said that you're not providing enough charity care. You're not providing enough free care to the community. And Tower tried to say, well, wait a minute, we provide significant services to Medicaid and Medicare beneficiaries. And the judge said, no, this is a charity care standard. And Haley, in the last part of the presentation, is going to talk about the tax exemptions standards, community benefit, et cetera, et cetera. Here, he was clearly working toward a charity care standard, not a community benefit standard. That's number 1 takeaway. And number two, he also looked at things that we deal with all the time. And you want to take a lot of this stuff back to your respective institutions and take a look at this. With regards to number one, $43 million of management fees paid by the 3 hospitals to the tax-exempt parent. Had a problem with that. Number two, had a problem with executive compensation at the Tower Health corporate level, number one, but also with respect to incentive bonus plans paid out to the executives of the hospitals, potentially that were based upon financial performance. And number three, 90% of the physicians at the institutions were non-W-2'd. They were medical staff physicians out in the community that had admitting privileges, number one. And number two, they were physicians owned by and employed by an entity called Tower Health Medical Group, which is common in all of our healthcare system examples, right? One tax exempt or one PC in the healthcare system. And the judge had a problem with that and said it's really owned by the corporate parent. It's not owned by our 3 community type hospitals, and basically denied exemption from a state level. And that is working its way through an appeal right now. So listen, again, we spent a lot of time here talking about corporate structure today, type of entity, sales and use tax issues, federal examinations and state and local examinations looking at these types of arrangements. And you want to do everything you can to try and portray the exemption of the entities, entity by entity, in the best available light, whether it's the 990, community benefit, and other sorts of economic data out there that Haley's going to talk about in a little bit. But this is a very good example, and everybody should be using this. That's kind of the standard out there for purposes of their entities at a state and local level. So then on the next slide here, these are just some of our recommendations and takeaways as you look at applications for exemption. And my last point here before I transition over to our last polling question and pass the baton, I think, back to John for part 5, has to do really with looking at the entities. And it's not just the entity itself, but for example, if a C3 owns a medical office building or an oncology center, those specific entities can also be challenged for local municipality purposes and non-exemption, as the municipalities seek to try and get tax revenue from tax exempts these days as well. So you think about it at the state and local level, the municipality level, and it's just not the legal entity itself. It can peel back parcels of property, buildings, and activities that you're doing that generally furthers exemption and clinical activities, but can be challenged at a municipality level. And I've been involved with them for expert witness purposes. They look at the 990, they ask about executive compensation, they talk about Schedule H, and they're looking at all those sorts of things. And those are considerations you need to think about clearly at that local level as well, and not just the state level and a federal level, and getting numbers into a tax return and rolling with it on an annual basis. So that's all I have here. I'm going to toss it over to Rachel for polling question 5. Thanks.
Great, thank you. So our 5th polling question: what is the current federal tax rate for excise taxes on remuneration paid in excess of $1 million to covered persons? About 30 more seconds. I'm gonna go ahead and close it out. And here are the results. Looks like 60% of you voted 21%.
Great. Yeah, that's right. 21% is correct. You know, that coincides with the corporate tax rate, which was implemented part of the Tax Cuts and Jobs Act. So yeah, 21% is the correct answer there. All right, so this next section, part 5, we're going to cover section 4960, an excise tax on remuneration greater than $1 million. So on this next slide here, if we have any sports fans out there, you've seen over the past 6 months or so, you've seen the coaching carousel going around, new coaches getting very lucrative contracts. What's interesting in this is that U.S. Representative Bill Pascrell, the chairman of the House Ways and Means Committee, had issued letters to 6 colleges and the 6 colleges and universities noted here, basically requesting information on how the university's lucrative athletics program is furthering, the educational purposes for which these universities receive their tax exemption, in light of the excessive compensation that, the universities are paying their current and former coaches. Some of these coaches are getting some sweet gigs there with, some benefits and pay that's, pretty excessive there. On the next slide here, we have identified 4 questions that were in these letters that we thought could pertain to other tax-exempt organizations, that are on this webinar today. The first one is, what categories of employees receive greater, more than $1 million of compensation this year? I think the second one is a real big one here. What factors, and criteria utilized to determine, the size and scope of these compensation packages? Who approves these compensation packages? The next slide, we have something, we talk about the rebuttable presumption of reasonableness. How do these compensation packages, meet those requirements there? The third here, any non-cash compensation that was received, health benefits, life and other forms of insurance or in-kind property. You've seen some of them getting use of a private jet or paying for their former home. This seems a little excessive there. And then lastly, what, total compensation paid to former employees as part of buyout agreements. You see a lot of these employees getting fired before their contracts are over, and then being bought out of the last couple of years of their contracts. For tax-exempt organizations, you just want to, I think with number 2, having, an approval process there to make sure that it is reasonable, is one of the major items here. And I think, Representative Pascrell is really asking these questions to really determine if the compensation to these coaches is reasonable and at fair market value. The next slide here just outlines the rebuttable presumption of reasonableness. This was promulgated to help, tax-exempt organizations avoid overpaying, individuals and determining, that total compensation paid to these individuals is reasonable. The 3 factors that need to be satisfied in order to receive the rebuttable presumption of reasonableness are labeled there. There's a compensation arrangement is approved in advance by an authorized body of the tax-exempt organization, composed of entirely of individuals who do not have a conflict of interest with respect to the compensation arrangement. The authorized body obtained and relied upon appropriate data as to comparability before making its determination. And then lastly, the authorized body, adequately documented the basis for its determination concurrently with making that determination. To satisfy by satisfying these 3 factors, it really pushes the burden of proof to the IRS to prove that compensation is unreasonable. And, we've worked with, clients coming on, that they state they are in, meet these requirements, but when you look closer at it, they don't meet all 3 factors here. Might not have a compensation study performed, or independent compensation committee who reviews and approves the compensation arrangement. So this is, important to make sure that your organization is in line with the rebuttable presumption of reasonableness. Next slide here. Just wanted to point out here, the IRS has not been quiet regarding the focus on executive compensation, since the release of 4960. In early January, a compliance strategy was announced, and, we've certainly seen this come to fruition. On the next slide, we've seen compliance checks with regards to 4720. They're sending these compliance letter 4204, compliance check information request. Basically looking at your organization's 990, they see that you noted that an employee received remuneration in greater than $1 million. They're asking why, why you did, if you didn't file that it's 4720, can you send a copy of it? And then if there wasn't a reason why you're not filing a 4720, why it's not required, please explain why. And, the biggest item that we, with organizations here, we're on the first year with the June, our June 30th year-end clients, June 30th, 2019, the instructions stated that, the effective date of 4960 was for tax years beginning after 12/31/17. And there's a specific example in there in the 4960 rules, basically saying that you're only required to remit excise tax on that portion of remuneration paid during the calendar year ending with or within the organization's tax year. So in this example for June 30th, 2019 year-end client, you're reporting 2018 Form W-2 on your 990. So you'd only have to look at remuneration from 7/1/18 through 12/31/18 to determine if the excise tax applied here. And then if there's no response received by the IRS, they'll refer the case to examination. And then lastly, some other items they add on to there, like say if your organization, if they're saying that the organization didn't file a 720 for a specific quarter, they'll request that, or are missing a 990T and asking for a signed copy of that. Next slide here, we just wanted to cover some best practices, for your organization. Really review and consider, your Form 990 Part 7 listings, and your next 5 highest paid employees. We've seen this as kind of a planning opportunity, not to avoid excise tax, but really to reduce the number of employees on your 990. Look at your website, your titles of your organizations, senior leadership on entity by entity basis. There might be some individuals that no longer need to be reported on your 990. Look at those your direct reports. There might have additional people on the 990 that can be reduced because they're reporting to someone that's already on the 990, and they're the person that's kind of in charge of that department there. And then also we've seen, some organizations moving employees to corporate payroll, but they still work on, they spend 100% of their time on that affiliated, hospital. With 4960, you should really be reporting if they had remuneration in excess of $1 million, that excise tax payment on that specific hospital, even though they are getting a W-2 from, say, the corporate parent entity. And then look at deferred compensation vesting schedule by an individual, try to maybe line those up. You might have some individuals that vest in a year versus the other, and then they jump into that reporting purposes for excise tax and leap over maybe those top 5 employees. And then one item that we've, done with our clients too is, including in a narrative form in Schedule O, anyone compensated over $1 million in Part 7 in which, excise tax has been paid by another entity. Say you have the CFO who sits as a voting member on the board of an affiliate, their compensation is reported there from a related organization from over $1 million. You might get one of those compliance checks asking why you didn't report pay excise tax on that specific entity. We found it beneficial to include this narrative saying, this employee's just a voting member, doesn't involve, not involved in the management of the entity, but, and their excise tax is reported on this specific entity with their EIN. And then also if you have some clinical folks that are over $1 million, licensed medical professionals, that are over $1 million, we've also seen that where the IRS is questioning how come no excise tax was paid on those. But you have that clinical, licensed medical professional and clinical services exception there. So we like to include a narrative in the 990 for that. And then on this last slide here, some considerations, with respect to 4960, with vested remuneration, including vested but unpaid earnings accrued on deferred amounts. That's treated as paid before the effective date of 4960. That's not subject to excise tax. And then another item here we see here a lot, organizations looking at is split dollar life insurance loan arrangements. Basically, the employer makes a loan to the employee to pay the premium on a cash value life insurance policy owned by the employee. For 4960 purposes, and is not considered wages and not subject to the excise tax. But it is treated as a loan with the interested person that's reported on 990. So you would be required to report that in your 990 on Schedule L, Part 2. And this is a possible planning opportunity for organizations. We've worked with some clients, converting, working with their compensation committee, outside comp consultants to maybe convert a 457F non-qualified deferred compensation plan to a split dollar life insurance loan arrangement. As noted above, in that slide on those couple bullet points, not considered wages and not subject to excise tax, but will lead to disclosures on the Schedule L of your 990. But definitely a planning opportunity that you can look into there for your organization. I think now I'll turn it over to Rachel for the 6th polling question.
Here is our sixth and final polling question. What percentage did the Senate Finance Committee try to implement as a minimum community benefit percentage for tax-exempt hospitals? About 30 more seconds. All right, I'm going to go ahead and close it out. And here are the results. Looks like the majority voted for 5%.
Perfect. Thanks, Rachel. Yes, the majority is correct. And I'm going to take you through community benefit in Part 6. And just quickly on the next slide, we've outlined for you why it's important. For the clients on the call, we talk about this at every audit committee presentation, and obviously it supports your federal, state, and local tax exempt status. On the next slide, we've included an article which is from based off of a report, which is on the following slide, that we've included a link to for you. Basically, the Loan Institute published for the first time an index which ranked hospitals in terms of their hospital spending and charity care, and unfortunately, I guess Cleveland Clinic was deemed to spend the least on charity care and community investment over any other U.S. hospital, compared to the tax breaks received by the federal government. So you can move forward. Actually, Rachel, I'm going to have you go to slide 57, please. And this is just to touch upon some more benchmarking reports available for you. We strongly encourage all of our clients to annually benchmark against the AHA 2018 report. Yep. And what that does is it provides, this is a report that's given out annually that summarizes community benefit provided by tax-exempt hospitals. And in its most recently released report, the community benefit expenses counted for 10.3% of overall hospital operating expenses, and you can see that on the top left corner of the slide. And then what AHA also does is kind of expands that information, and so it allows you to benchmark on a more granular level, broken out by size of the hospital. So a small hospital is up to $1 million of expenses versus your location. Obviously, there's going to be some big differences between rural and urban hospitals, and how much of their community benefit is based on the certain buckets or categories. And lastly, by type, general acute care hospitals versus children's hospitals and teaching hospitals. So this is just some really great information. And on this slide too, you'll see that they also include what's considered total benefits to the community. So it's your starting point of community benefit plus your community building activities, Medicare shortfall, and bad debt attributable to financial assistance. And you could go to the next slide. Some Schedule H planning areas, Scott talked about EMR. Obviously, the subsidies there are potentially includable and something we'd recommend everybody go back and take a look at. Telehealth, with the increase in telehealth availability, obviously some of that was offset with FEMA or CARES money, provider relief money. But going forward, this is something that organizations, especially if you've expanded your telehealth services, should take a look at for including in for community benefit Schedule H purposes. We talk about it often, subsidized health services. It continues to evolve, and something that the organization wants to take a look at, areas of opportunity on an annual basis, and social determinants of health. And this is, a big topic. We've listed out the The areas of social determinants of health on the next slide. Basically, you want to be discussing these activities with your community benefit coordinators as well as your tax practitioner or preparation firm, because there's a lot of this going on within the organizations. It just may not be communicated to the right folks. So take a look at this and make sure that any of these social determinants of health, there's certainly an opportunity to include that in community benefit, whereas it used to be included in community building. And I missed on the last slide, but you don't have to go back, Rach. What we've been doing with our hospitals recently is taking a look at bad debt. What we're finding is the bad debt keeps growing and growing and growing. And so sometimes it makes sense to do a revenue cycle review. Basically, what does your financial assistance policy say? And if your bad debt continues to grow and you aren't getting paid for it, it's not helping you for Medicare cost report purposes. It's not helping you for Schedule H. So it may make sense to review your financial assistance policy and maybe increase the eligibility criteria so that some of those folks can kind of get out of bad debt and fall into a charity or discounted care. And that's something that is yielding very well for our clients when they take a look and a deeper dive into it. And on the next slide, we just wanted to include a couple of examples of how obviously there's an increased value on community benefit and tax exemption. We saw it with the article that came out about Cleveland Clinic. These are just some examples of other articles where certain organizations are actually making the claim that nonprofit hospitals spend less on charity care than for-profits. There's just a lot going on in the industry, and so we just wanted to make you aware of some resources that you can go to check this out. On the next slide, obviously, states are getting involved. This is actually a super cool website that we found to be really helpful. We did include a live link, and basically it talks about what the state community benefit requirements are. And so if your organization is expanding, definitely something that you want to take a look at. And these last couple of slides, we just included a couple of pictures, so Rach, you can flip through them, but both your New Jersey Hospital Association and HAP have done a really great job of putting together these economic impact reports. And so we encourage all organizations to leverage these reports because it not only talks about the community benefit and community building that you're providing, but all the other factors. You're employing this many individuals, you're spending, basically reinvigorating state government. And so what you want to do is leverage these reports and make sure that you include this information in your 990s, in your marketing materials. It can definitely be beneficial, and it's something that you certainly want the reader of the 990 to be aware of. And with that, I will turn it over to Scott to close us out.
Okay, I'm back. Hey, great job, Haley. John, great job. We also included an appendix of all the IRS things going on out of TEGE these days. And last kind of takeaway here, the IRS is a mess, right? If anybody has tried to deal with the IRS these days, it's impossible. Thank you, Rodney, for joining us as well. And it is a mess. Here's the biggest takeaway. If you receive a notice with a small amount of tax to pay or a notice of intent to levy, pay the tax, write the letter of abatement, and then try and fax it to a fax number. Don't mail it. If you try and write the traditional abatement letter, it's going to sit somewhere at the IRS. It's not going to be processed, and then you're going to be dealing with an intent and a garnishment on your Medicare wages, on your Medicare fees that you receive for providing clinical services. We've had some instances of those and had to help out our clients. There's an enormous backlog of paper being processed at the IRS, whether it's 1040s, whether it's the employee retention tax credits. The IRS hopes to get that backlog down to 1 million by the end of this year. And we're only in third week in March, right? So quite frankly, if you file something now via paper, it ain't going to be looked at. Try and fax it, pay the tax, and then deal with it afterwards and try and get the money back is our best case recommendation. By the way, too, talking about getting your value for what you pay as taxpayers, the IRS budget this year just had a $675 million increase to $12.6 billion. And service is not what it's certainly what we should be accustomed to getting. So just a little bit on the tax end. hey, we covered a lot of stuff today, right? Federal, state, local things going on. We really tried to incorporate not only the rules or regulations, we didn't cover all the slides, you can go back and look at them, but we really tried to provide a lot of real life examples of what we deal with 24/7, 365 in the healthcare industry, working with our clients that we really thought would be valuable to you, that you can take back to your facilities, to your operations people, to your management team, to your audit committee and say, hey, we should look at this. We should look at transactions amongst affiliates, federal issues, state issues, local issues with respect to tax rules and regulations. So just a couple real life takeaways. Lastly, thank you for joining us today, number one. Also, thank you for everything you do in the healthcare industry. Now, throughout the pandemic, you've done incredible things. You continue to do incredible things. We're proud to service the healthcare industry. We're proud to call you for joining us today. Thank you, but also for being clients of Withum Smith & Brown. Most appreciative. Have a great day. I'm going to kick it back over to you, Rachel, to wrap up.
Thanks, Scott, and thanks, everyone. I see we got a few questions come in, but we want to be mindful of everyone's time, so we will be reaching out to you via email. We will also be distributing the slides and the recording of today's presentation within the week. Thank you, everyone, for joining, and have a great day.